Ladies and gentlemen, welcome back to the channel. Today we are talking about a massive reality check hitting Wall Street. The honeymoon phase of the artificial intelligence boom is officially over, and the market is nursing a colossal hangover. Remember the good old days? Just mention the letters A and I in an earnings call, and your stock price would spontaneously combust into the stratosphere. CEOs could walk onto a stage, whisper artificial intelligence into a microphone, and investors would throw money at them, like they were headliners at a Vegas residency. But times have changed drastically. The market has shifted from wide-eyed optimism to a cold, hard interrogation. Let us look at what just went down. Tesla and Alphabet both dropped their second quarter earnings reports, and Wall Street reacted, like someone had just told them that Santa Claus is actually a hedge fund manager. Alphabet took a 7.1% beating, while Tesla experienced a jaw-dropping 14.5% plunge. Why? Because investors are terrified that all this massive spending on AI infrastructure is eating away at profit margins, like a swarm of digital locusts. It turns out that beating revenue estimates is no longer enough. You cannot just waltz in and say, hey, look, our top line grew by 10%, while conveniently ignoring the fact that you just spent a small nation's GDP on microchips. Wall Street wants to see capital expenditure discipline. They want to know when the cash register is going to start ringing. Right now, companies are spending money faster than a teenager. With their first corporate credit card, at an all-you-can-eat tech buffet. Take Oracle as another prime example. Their cash flow has dipped into the red, and their stock price has been dragged all the way back down to pre-generation artificial intelligence levels. Gravity is a harsh mistress, my friends. When you spend billions of dollars on data centers, power grids, and high-end processors without an immediate return on investment, the market stops cheering and starts checking the emergency exits. And the drama is far from over. We are staring down the barrel of a massive earnings week. ARM Holdings and Meta Platforms are stepping up to the plate, followed closely by Amazon. The big question on everyone's mind is whether this skepticism toward AI monetization is going to turn into a full-scale panic. To truly understand this madness, we need to take a step back and look at how we got here. Picture the scene in Silicon Valley boardrooms over the past year or two. It was absolute chaos, but of the most exhilarating kind. Tech executives were pacing back and forth, sweating through their expensive designer hoodies, panicking about missing out on the next industrial revolution. The narrative was simple and terrifying. If you do not buy every single advanced graphics processing unit on the planet right now, your company will become obsolete by next Tuesday. You will be wandering the digital wasteland trading outdated software, while your competitors rule the cosmos with sentient algorithms. So what did they do? They opened the corporate checkbooks wider than the Grand Canyon. They ordered chips by the cargo ship. They bought up real estate for data centers that consume as much electricity as small European nations. And for a while, Wall Street ate it up. Every time a CEO announced a multi-billion-dollar AI initiative, investors cheered and bought more shares. It was a magnificent feedback loop of unbridled techno-optimism. But then reality showed up to the party uninvited, wearing sensible shoes and holding a clipboard. Let us talk about Alphabet first. When they reported earnings, everyone expected the usual victory lap. Google is an advertising powerhouse, after all. They print money, but the market looked past the strong revenue numbers and zoomed in, like a hawk on the capital expenditure line. The massive spending required to integrate artificial intelligence into search, cloud computing, and everything else triggered an alarm bell. Wall Street looked at the profit margins and said, hold on a second, where is the cash? You are spending a fortune to build this digital utopia, but the monetization looks like a slow burn. The stock dropped 7.1% in a flash. For a trillion-dollar company, losing that much value in a single session is not a dip, it is a financial earthquake. Then came Tesla. Oh, sweet chaotic Tesla. Elon Musk has never been one for doing things halfway. When Tesla leans into a narrative, they lean in so hard the whole vehicle tilts. Tesla has been framing itself less like an automaker and more like an artificial intelligence and robotics company. They need massive compute power for full self-driving, technology, robotics, and training their neural networks. The capital expenditure numbers were astronomical, but unlike software companies, Tesla has a heavy manufacturing business with notoriously cyclical margins. When investors saw the combination of automotive price wars, squeezing profit margins, and skyrocketing AI infrastructure costs, the panic button was slammed. so hard it broke. A 14.5% collapse is the kind of move that makes portfolio managers stare blankly at the wall and question their life choices. This brings us to the core psychological shift happening right now. Wall Street has officially entered the show me phase, the era of buying a stock, purely based on an executive's utopian vision of the future, is on life support. Investors want receipts. They want to see tangible evidence that pouring billions of dollars into data centers and large language models translates into actual bottom-line earnings growth. Think of it like building a massive state-of-the-art toll highway. You spend billions of dollars laying down asphalt, installing high-tech toll booths, and buying automated cameras. For the first 2 years, you have zero cars and negative cash flow. Your investors are looking at your financial statements and seeing nothing but red ink. You keep telling them, trust me. Once everyone starts driving on this road, we are going to be billionaires. But if people are taking a different route, or if the tolls are too high, your investors are going to start sweating bullets. That is the exact spot the tech giants find themselves in right now. They have built the most expensive digital highway in human history, and now the market is demanding to see the traffic. Let us look at Oracle as well. Oracle used to be the reliable, boring enterprise software company that your grandfather's pension fund loved. Then the generative artificial intelligence boom hit, and they jumped headfirst into the cloud and AI infrastructure game. They wanted a piece of that high-flying tech valuation, but building out cloud infrastructure to compete with the likes of Amazon Web Services, Microsoft Azure, and Google Cloud is an expensive game of catch-up. Oracle's cash flow dipped into negative territory, and the market reacted with swift and merciless brutality. The stock retraced all the way back to pre-AI boom levels. It is a cautionary tale for any company trying to play in the high-stakes poker game of artificial intelligence without a bottomless pit of cash. Now let us turn our gaze to the immediate future, because the plot is thickening rapidly. We have earnings coming up from some of the absolute heavyweights of the tech ecosystem. On July 29th, all eyes turned to ARM Holdings and Meta Platforms. ARM is an interesting character in this drama. They do not actually build the chips themselves. They design the architecture and license it out. They are essentially the architects of the modern semiconductor world. If everyone is building custom silicon for artificial intelligence workloads, ARM stands to make a killing in royalties. But investors are going to scrutinize their valuation very closely. ARM trades at a lofty multiple, to put it mildly. Any sign of a slowdown in licensing, revenue, or a cooling off in chip demand across the broader tech landscape will cause the market to reprice that stock faster than you can say semiconductor cycle. Then we have Meta. Mark Zuckerberg has gone all in on the metaverse and artificial intelligence. Remember when the market punished Meta for spending too much on virtual reality? Zuckerberg pivoted hard, embraced artificial intelligence, rebranded their efforts around open source models like Llama, and the stock soared back to record highs. But the capital expenditure numbers for Meta are once again reaching eye-watering levels. They are building massive data centers, packed with thousands of high-end processors. Investors will be grilling Zuckerberg on the return on investment. How is all this open-source AI making Meta more money in advertising? Can they squeeze more engagement and higher ad rates out of these systems to justify the billions being spent on hardware? If Meta gives any indication that capital spending is going to outpace revenue growth even further, the sell button will be working overtime. And as if that is not enough excitement for 1 week, July 30th brings us Amazon. Amazon Web Services is the undisputed heavyweight champion of cloud computing. A massive chunk of the corporate world runs its digital infrastructure on AWS. And guess what? Corporate customers are rushing to deploy artificial intelligence workloads on AWS, but AWS is also bearing the brunt of the infrastructure costs. They have to buy the chips, build the data centers, and secure the massive amounts of electrical power required to run them. At the same time, Amazon's retail business operates on razor-thin margins, and consumers are feeling the pinch of economic uncertainty. Wall Street will be dissecting every single metric coming out of AWS. Is cloud growth accelerating enough to justify the capital expenditure surge? Are enterprises actually deploying production-grade AI applications, or are they just running expensive experiments? The stakes could not possibly be higher. If ARM, Meta, and Amazon deliver strong numbers and reassure investors that their capital expenditures are generating healthy returns, the market might take a collective sigh of relief and resume the upward march. But if they echo the cautionary notes of Tesla and Alphabet, we could be looking at a sector-wide correction that redefines the tech landscape. For the rest of the year, it is fascinating to watch this dynamic play out because it highlights a classic Wall Street paradox. Investors want innovation. They want companies to be bold, visionary, and disruptive. But the moment those companies actually spend the money required to be bold, visionary, and disruptive, investors panic about the short-term impact on profit margins. It is like wanting a brand new high-performance sports car, but throwing a tantrum when you see the price tag at the dealership. Tech executives are caught in a classic catch-22. If they do not invest aggressively in artificial intelligence, they risk missing the boat and getting crushed by competitors who did. But if they do invest aggressively, they get slaughtered in the stock market for hurting their near-term profitability. There is literally no winning in the short term. You are damned if you do, and you are definitely damned if you do not. So how should we, as observers and market participants, process all of this? First, we need to recognize that we are moving past the initial hype cycle and entering the messy, difficult phase of technological adoption. Every major technological revolution in history has followed this exact script. Think back to the dot-com bubble in the late 1990s. The internet was undeniably the future. Everything that was said about the internet eventually came true, and more. E-commerce, digital media, cloud computing, social networking, it all happened. But in 1999, investors piled into anything with a .com in the name, drove valuations to absurd heights, and then experienced a catastrophic crash. When the companies failed to monetize quickly enough, the infrastructure, the fiber optic cables laid across the ocean floor was overbuilt for the immediate demand. It took years for software and business models to catch up to the physical infrastructure. Are we seeing the exact same pattern with artificial intelligence? In many ways, yes. The enthusiasm is real, the technology is profound, and the long-term impact on global productivity will likely be staggering. But the capital deployment has gotten ahead of the commercial reality. Companies are laying the fiber optic cables of the AI age right now, and the stock market is throwing a tantrum because those cables cost a lot of money and do not generate instant profits. Second, we need to pay very close attention to which companies are actually capturing value. There is a huge difference between being a consumer of AI infrastructure and being a supplier. Chip designers and foundries like NVIDIA and potentially ARM sit at the toll booth of this entire movement. They get paid up front regardless of whether the end user makes a profit on their AI deployment. But companies trying to monetize AI through software services or advertising face a much trickier path. They have to convince enterprise, clients, or retail consumers to pay extra for AI-enhanced features. If customers are not willing to pay a premium, those capital investments are going to look like very expensive vanity projects. Third, let us talk about the macroeconomic backdrop. All of this is happening in an environment where interest rates are no longer at zero. For over a decade, tech companies could borrow money for practically nothing, which made aggressive, speculative capital expenditures feel relatively painless. You could fund massive moonshot projects with cheap debt, and nobody would bat an eye. But today, the cost of capital is significantly higher. Money actually costs something now. When interest rates are elevated, investors scrutinize cash flow and capital allocation with a fine-toothed comb because companies have safer alternatives to generate yield, like sitting in short-term government bonds. The era of free money is gone, and the artificial intelligence build-out is happening on a much more expensive balance sheet. As we watch the earnings roll in over the next few days, keep your eyes on the key metrics that actually matter. Do not just get distracted by headline revenue beats. Look at the capital expenditure guidance. Look at the free cash flow numbers. Look at management commentary regarding the timeline for monetization. Are corporate clients actually deploying these tools at scale, or are they still in the pilot phase? The stock market is essentially voting on whether artificial intelligence is a generational profit machine or an expensive distraction. Right now, the bears are having their day in the sun, and the tech titans are being forced to defend their spending habits in front of a very skeptical audience. Will Meta, Amazon, and ARM be able to calm the nerves of Wall Street? Or are we standing at the precipice of a broader tech correction? As the reality of capital-intensive innovation sets in, the next few days will give us a massive piece of that puzzle. Grab your popcorn, keep your seatbelts fastened, and let us watch how this high-stakes corporate drama unfolds.